Folks, I know everyone's thinking about coronavirus. Is the market going to crash? Is the market going to skyrocket? What's going to happen? But there's a lot of things that people are not thinking about right now. And that's my job. My job is to bring to you things to get you that, wait a minute, why haven't I thought about that? Right now, the biggest factor is not whether the market's going to go up or down. The biggest factor is how big is your position. Now, usually, I've talked about this topic a lot, but right now, I don't think there's a better time in history. There's no better time in history than to talk about volatility than right now, because we're having the biggest volatility that we've had in 20 years. And fear levels in the market are just running. The fear is volatility is at the highest level since the 1988 crash. All right. So things are getting wild, but I want to show you something interesting, and I want you to think about this. So this is the S&P 500. This is the SPY. This is the SPY ETF. This is the exchange traded fund. You could trade this like Tesla, like Amazon, like Apple. And as a matter of fact, after we're done with SPY, I'll do it on another stock. I'll start with SPY. So I want to show you something interesting. Let's say that you're trading a basket of stocks that consists of the stock market, the S&P 500. Let's say you have a couple of tech stocks, a couple of healthcare stocks, a couple of material production, energy stocks, and so forth and so forth. And you have a fairly good basket of stocks. And let's say you have 100 shares, okay, total. Or let's say you have 100 shares of SPY. Well, if you look at this indicator tells us volatility. ATR has nothing to do with direction. And I know everybody's thinking direction. Everybody's focused on direction. But think about something. If you're trying to protect yourself and you have very, very few shares, does it really matter if the market goes down? If you have 5 shares, for example, all right, and you typically have 1,000 shares, would it make much difference? Probably not. So you see, the amount of shares you have plays a vital role in your risk, in how to figure out how many positions you have, how many positions you should add, how many positions you should take away, because volatility plays a role in your account. For example, let me show you this in real time. Let's say that you're holding 100 shares of SPY, 100 shares of the S&P 500. And let's say you're holding it between December 23rd and, say, February, somewhere in that ballpark. If you look at the volatility, this tracks the average of the 10-day volatility. If you look at the volatility, you'll see that the volatility goes anywhere from $2.40 up to about $2.30. You could see the number right here. And you could see here it goes up to about $5, and then it comes back down to about $2.50, and then it starts really moving up. So let's say we're holding, for argument's sake, let's say we're holding the 100 shares of SPY around January, right around here, where volatility is about $2, $2.03, $2, but let's just say $2. That means every day your 100 shares gives you a volatility of $200. Why? Because fluctuates $2. You have 100 shares, right? For every 100 shares is $100. So fluctuation-wise, you have 100 shares, $2. Multiplied 2 times 100, it's $200. It's just that simple. But look at this scenario. Assuming nothing changed, assuming you're still holding the same 100 shares. Let's look at the volatility the last few days, and it's been going higher and higher. Volatility now is close to $20. It went all the way, and now it's at $19.73. That's the average 10-day volatility trading range. So imagine you still have 100 shares. Well, your fluctuation every day now is $2,000. Now think about this for a second. Did you increase your share size? Nope. Did you lower your share size? Nope. You still have 100 shares. But the risk to your account is now $2,000, not $200. How could that be? Because you're not equalizing shares. You're not adjusting shares for your account. So for example, let's say you want to risk 2% of your account, okay? just say 2% of your account. And let's say your account is $5,000. 2% of your account would be, let's see, 2% of it would be $100. That means you would have to reduce your position size in half when volatility was $2, right? Right? So the point I'm making is a lot of traders out there, even right now, they're not taking volatility into account. Volatility, this ATR indicator, this is what 90% of hedge fund managers are doing day in and day out. They're looking at volatility and they're comparing historic volatility to their account size and betting X amount of volatility. So the question should not only be which way is the market going. The question should be is how much volatility is your portfolio going through right now compared to a month ago? So for example, let's say, for example, that I liked my $2 volatility. I was comfortable with that. I was getting $200 up and down range. Well, the market now is doing 10 times that. $2, $20. Again, it's $19 and whatever it is. It's $19 and here, let's see, 91 cents. But let's just say $20. Let's say $20 and $2. That's 10 times the volatility. So you know what a hedge fund manager would do? He would cut his position size in half, in 1/10, as the market is moving higher. When it went from $2 to $4 to right here, let's see, yeah, right around here, we would go from 100 shares to 50 shares. And when we get to about right here, about $8, $9, we would cut it in half again. And then finally, when we get to about here, we would only have 1/10 of our position. We would only have 10 shares. And guess what? Our account, our portfolio, would still give us that $200 volatility, that trading range that we would have when volatility was up here. Now, the ATR, I use a 10-day ATR. Let's say you don't trade the SPY. Let's say you trade, let's say Apple. How about Apple? Let's do this example on Apple. Folks, this should be eye-opening because, again, everybody's wondering where the market's going to go, but nobody's looking or talking about volatility. And volatility is what 90% of hedge fund managers focus on. So again, let's just say Apple around here, volatility around these level, beginning of January. I see it's going between $5 and $6. Let's just say $5 to make it simple, all right? So let's say you have 100 shares. Your exposure in Apple to your account would be about $500 per day, right? $5 fluctuation, 100 shares, 5 times 100 is $500. But let's say you're holding Apple and now you're holding Apple even now. Well, exposure is now closer to $20. Again, I'm keeping the numbers even to make the examples easier. So let's say we're right here and let's say volatility went from $5 to $20. Well, you don't need 100 shares. You can get the same bang for your buck right now, with all this crazy volatility out of 25 shares. 25 times 20, right, is $500. So again, the 100 shares you needed right here equals only about 25 shares here. So folks, one of the biggest factors I want you to consider when market volatility goes haywire is look at the ATR indicator. It's a simple indicator. You look at the study, you look at the ATR indicator. It has a smoothing period. You want zero. You don't need any smoothing. You just need 10-day ATR. That's all you need. You apply it right here, and you will see what the dollar range for every share, what the average volatility is for the day. And you probably are thinking, why do I need this ATR indicator? Folks, if you are not using the ATR indicator, then you're not managing your account correctly. Because what if one stock volatility is like this and the other stock volatility like this, and then they change the other way around? But you bought more shares here, you sold less shares here. You see what I'm saying? It's hard to keep things equal. Or right now, you're probably thinking, oh my God, my account used to fluctuate $5,000 a day. Now it's fluctuating $100,000 again today. Folks, volatility is right now about 10 times higher than average, which means your positions, that means you can get the same bang for your buck with a position size that's on average 10 times smaller. So always keep an eye on the ATR indicator. It's not going to tell you where the market's going to go, but it's going to tell you how much risk you need for the shares that you have. And that's the difference between an amateur and a professional trader. Hope that helps.